Where are the rates exactly? I'm going to answer that in all of the pressing questions that everybody has right now about where we're at, where we're headed, what's going on, and what you should do. So let's start with the rates. I have this recorder, but if I make it bigger, it gets all distorted. So I'm just going to have you flow with me on where we're at. I had done this chart coincidentally back in 18 in August, September, when the rates went up. And historically, rates go up, demand goes down. Rates go up because affordability increases and people's purchasing power is decreased. An interesting thing, though, about this market is we have had the last 18 months only the elite buyers in the market, the buyers that have high credit scores, have a lot of money down, can pay over. So the profile of the buyer the last 18 months, which has been super hot, have been these highly qualified people. I don't necessarily think that the rates in the fours are going to deter these people. And if February was any kind of an indication, which it is, we didn't have a slowdown in demand. Now, March, we don't have all those final figures out, but I haven't seen demand fall. I'm seeing people out there in droves wanting to buy. However, the last couple of weeks, the rates are starting to concern me a little bit because I thought we were going to plateau in the fours, maybe for those credit, people with bad credit or lower credit scores, not necessarily bad credit, right? Because a 650, 660, it's not terrible. It's financeable. But we're seeing these rates. If you look at this chart, one thing that you will notice is all the fives, okay? And I want you to show me some love right now, because this took a lot. This is 16 or 17 scenarios that we had to hand price out. And I built some templates around this, so we'll be able to log in and update this every other week or so. This is TDR Mortgage rate estimates. This is a rate estimate based on this set of criteria: 720 FICO, 450 or so loan amount. These rates do not include any points unless otherwise noted. 995 processing, no discount points or other fees unless noted. When you look at all these pure things, right? FHA, VA, conventional, these are just regular notes. And then we added over here on a 20% high balance purchase, there was bang for buck in paying a point. Same thing with this 25% conventional investor purchase. If you are a real estate professional, please just respond to the email and we'll gladly send you a PDF. This is not to be used for consumer purposes other than my past clients. I want you guys to take a look at, where we're at on our refinances. Take a look. Okay, 15-year, 720 FICO, 3.625. We were just doing these a few months ago down in the twos. 2.3, 2.5, 2.6. I think we just closed a 15-year at 2.6 a month ago. So this is a lot of heavy rate movement. Keep in mind too, let's see. Okay, so we have FHA. So you're going to find that around 4.375. VA 4.25. VA is usually a little bit less. 3%, 5.25, 5%, 4.8. And your regular basic vanilla, 20% conventional borrower is 4.8. The high balances, if we didn't have this point, these high balance loans were in the mid fives. And if you have a lower credit score, these high balances are going to price in the sixes even. It's not very pretty. So we tried to use this generic 720 score as like a marker so that people could see. 75, okay, loan to value, that's your equity position. So you have 25% equity, no cash out refi, 4.75. So if you've got an FHA loan at 2.5, it is going to make zero sense for you to refinance. We are seeing some people benefit by high cash outs where they're taking 100,000 or 150,000 out to do debt consolidations. That is an individual, all of our loans are individual case by case analysis type of situations where we're going to look, this is not this 720 credit score. This is not every borrower. So when you look on here, don't be deterred by not calling us to check. And also keep in mind, when you're in your bank, when you're in your bank, or you see those low rates advertised, those rates are always, you look at the fine print, it's a 780 credit score, it's a 60% loan to value, and it's 1.75 points. So keep that in mind too. I'm recommending right now in the short term that we don't pay points. Oh, Minnie, come here, Minnie. That we're not paying points. The next time we go into a recession, which, we will eventually, when I don't know, nobody knows, but there's so many things going on. Where is inflation? Where are we going to end up with inflation? And these high rates going up, eventually it will impact the housing market. It just depends on what is the tolerance level? What's the pain threshold? If you get here, let's say, if you're in these conventionals, and what if this 20% down conventional goes in the high fives or the mid sixes? Is that going to be enough to deter somebody from buying an $800,000 house? How high is it going to have to go to where it really puts a strain on housing demand? I don't know. I do know that some of the amazing people that I follow, where'd it go? Oh, one of my friends and people that I follow, Mr. Stephen Thomas, puts out a housing report. This is for San Bernardino County, but this will pretty much universally apply to all the counties in Southern California. And his latest newsletter is out of control, with the number of available homes to purchase at extremely low levels. There simply are too many buyers competing against each other. And so I think what he's trying to illustrate is that now it's not like a crisis. It's pretty serious thing that we have going on. And not only is it with home sales, but it's also with rentals. I know I recently had a property that we rented out, and I was shocked at the amount of people that were willing to pay over the listed price, and just the shortage. When you look at certain inventory and you're looking at a whole city and there's only 5 properties for rent, it's pretty shocking. Now, one of the things that a lot of economists, a data person like Mr. Thomas, he's saying that in order to get some kind of equilibrium in our market, our rates have to go up. There's got to be something. This is not sustainable. The kind of growth that we've been having is simply not sustainable. If you look at California, this is showing 19%. I know areas in the Inland Empire that went up 35% in 1 year. In Arizona, 27%. I think it's 25% in Florida. And certain counties, it's even more. And that is just 1 year. We simply didn't build enough housing units in the last decade to afford people enough housing, coupled with the permit process is so restrictive and is so cumbersome, expensive, and a long lead time to get projects off the ground, that we're in this kind of like critical area that we will not see ourselves out of for a few years. So where does this leave us? Right? Well, should you purchase a home really goes to, is it at or a little bit higher than what you would pay in rent? Or even let's say it's $1,000 more than what you'd pay in rent. I know a lot of areas in California where rent has gone up 25 or 30%. So buying a home is going to be a wonderful mesh of leverage against future home prices. Again, it's not a one size fits all thing. I wanted everyone to get a peek of what we're seeing. And every day we're getting rate increases. Today, well, Monday, it came out worse than Friday. Tuesday, it got a little bit better. It got a little bit better today. And then it's going to level up at the end of the week. We're in a super strong lock market right now. Moving forward, if you are thinking of selling your property, it's probably a pretty good darn time. You might be able to get more out of it in the next year. You might. But what if this inflationary time, what if our economic environment, what if the rising rates really does put a slowdown on demand? Being able to sell your house right now at the tippy top of the market is something pretty spectacular to be able to do. Timing the market is not an easy thing, right? It's never an easy thing to do. There are a lot of people that try, and some people just get lucky at it, I think. If you're looking to refinance, don't be distraught if you can't do it right now. I always say, just give us a call. Let us run the numbers. It takes us just a few minutes. We don't have to pull your credit. We can just kind of give you a rough idea over the phone or in an email. And if you do, if you kind of miss the boat in refinancing, don't worry. There will be a future opportunity to refinance during our next downturn. Because what happens? What happens when the economy isn't going so well and we're in a recession or depression? The government comes in to save the day, to stimulate the housing market, because that overall contributes to the health and wealth of the economy, and they reduce the rate. So I really think, in a lot of smart people that I follow, that their sole job is to evaluate the market, have all indicated that that will be the case. In any event, for information and assistance with buying, selling, or refinancing in Southern California, pick up the phone and call us at 909-920-3500. My name's Teresa Timms, and I'm president of TDR Mortgage and Real Estate Group in Southern California.